Hello, today we're going to be talking about the further changes that were announced in the summer 2015 budget in relation to the taxation of pensions. These come on top of a raft of additional changes that have been made in recent years, which create a complicated challenge for many employers. I'm Ben Wilkins and I'm joined today by Philip Smith and Kate Harris. So Philip, can you first perhaps just run us through what the key changes were that were announced in the budget?
Yes, Ben. So the most important changes were that for higher earners there's going to be a reduction in the annual allowance, and that the lifetime allowance is going to be reduced from 1.25 million to 1 million from April next year. The way that this is going to work is that for employees who have earnings above £150,000, they will see their annual allowance taper down by £2 for every £1 above this amount, so that by the time earnings reach £210,000, they will only be able to pay £10,000 into their pension tax efficiently. Importantly, it's the first time that pension contributions are going to count in the calculation of the income figure. So you could see individuals with incomes down close to £100,000 potentially being affected. The impact of this for most organisations is that a whole new raft of people are going to be affected by pension change, by pension tax change that haven't been affected before. And so companies are going to need to think quite carefully about how they deal with this situation. Right. Otherwise you could find groups of people ending up with unexpected tax bills.
Okay, and so Kate, what are companies thinking about in relation to these changes? What kind of actions are they taking?
So our discussions with a number of UK companies over the summer have revealed two key client concerns. The first is around the complexity of the changes themselves and how companies should respond and react. And the second is about the depth or the extent of the changes and how deeply that can go into the employee population. Mm-hmm. So really individuals with salaries of around £110,000 per year could be impacted because of the way that income is calculated for the purposes of the annual allowance.
Right.
So I think it's clear that the approach of just rolling down the previous responses to annual allowance and lifetime allowance changes is probably not going to do the trick. There will probably be far too many people impacted to do that effectively. And also the calculation of the annual allowance has got far more complicated. We have a transitional period, as Philip has mentioned, and then we also have a taper to contend with when the annual allowance is being calculated. So as a starting point, companies are tending to look at their employee populations and segment them into three buckets. The first bucket are those people who are earning well below 100,000. Mm-hmm. So those individuals are not affected by the changes that have been announced. They may be in the future, but for now they're relatively easily dealt with. The second bucket then are those who are earning over £210,000 per year. Their income is over 210. Then again, relatively straightforward because they are clearly affected and their annual allowance from next April will be £10,000. The trickier bucket are those people who have income between £150,000 and £210,000, because those people may very well be affected by the reducing annual allowance and the taper. It's particularly difficult to predict the population in that bucket when they have variable pay like LTIPs and bonuses.
Okay, thanks Kate. So Philip, there's lots of complexity there. What kind of actions should employers be taking now to avoid falling foul of these new rules?
Okay, so I think the most important thing is that employers get to grips with the scale of the problem in their organisation, and that they get ready to provide employees with enough information to help them make some potentially quite important decisions that need to be made between now and the end of the tax year. There is the opportunity for employees to make pension contributions now, and they need the information to be able to do that.
Right.
And going forwards, it's important to make sure that whatever the retirement savings arrangements are for higher earners in the future, that they remain fit for purpose. And we're certainly seeing a lot of clients rethink their overall retirement saving strategy for this affected group of employees.
Right, an important area. And I think, Kate, that brings us on to perhaps the broader reward strategy discussion. So pensions is a subset of that. And what are the implications for employers for their broader reward strategy?
I guess historically, pensions were a standalone part of the reward structure, and they had a particular solution, which was the company's pension scheme. With the changes that we've talked about today and the increasing flexibility there is in terms of the way that pensions can be drawn, that model may now not be suitable for everybody. So companies, I think, are starting to look at a range of options of how to respond to the changes. And I think the most successful options will be those that not only meet the immediate challenges of the change in legislation, but are also mindful of the strategic reward objectives that the company has.
Great. Philip, Kate, thank you very much. Hopefully this has given you a clear outline of the changes being made and the challenges of being an employer in this changing environment, and also what actions you should consider in the coming months. As ever, if you'd like to discuss these changes in any further detail or would like some assistance in where to go from here, please don't hesitate to contact your normal PwC contact or any of us presenting this webcast today. Contact details will be on our website. Thank you very much for watching.